Let's move on to our next guest of the show. We have Feroz Aziz, Deputy CEO of Anand Rathi Wealth, joining us. Feroz, good morning. India Inc.'s earnings have been quite slow so far, and the markets have been speaking the same narrative. So, how are you seeing valuations at the current juncture?
Hi, good morning, Lovisha. I think, like you said, the earnings growth have been a little tepid. But I personally think that the earnings growth on a base of 1,117, which is what Nifty's earnings for last year were, in fact, last year's earning itself requires some degree of clarification. The markets don't track it the way we track it. What is the difference is, if you ask anybody what's the earnings growth for Nifty last year, they'll say 6.5% from 1,049 to 1,117. But there were four companies which changed. Those four companies which came in brought in a lower base. So actual growth of Nifty earnings for the last year is not 6.5% as reported on NSE. It is 11.5% for the current 50 Nifty constituents. If you forget those four changes, that's the growth number. Now coming back to what kind of earnings growth we look at, I personally think that we have had about 26, 27 companies have given their results in Nifty. We are looking at a tepid growth, but I personally think that for the financial year, 1,250 rupees of earnings on Nifty are possible. If that were to happen, that's a great 12% growth. And I think I would stick to that guidance. So if that were to happen, medium term is relatively bright, and these are buying opportunities.
Okay. Feroz, but everyone was chasing the Nifty to reach lifetime highs in July and even August itself. Has that view changed at this point of time? Because so far India Inc.'s earnings have not been, something that we need to cheer for. And if you look at from the tariff and trade deal front, there also we are still hanging, while most of the developing economies has been inching towards the trade deal. So what is your view at this point of time? Are we still, can we see a limited upside from here on?
Lovisha, in my opinion, of course, previous highs have a sentimental significance. But I personally think that you can't rule that out. If you look at the July series, derivatives is something which we look at for barometers. If you look at synthetic futures of first week of August, it is quoting at 36 rupees. The implied value is 22, 23 rupees as per the forward they should quote. That implies some degree of bullishness for the subsequent Nifty series, which is 7th of August. That's point one. Point two, we're just about 1,500 points away from the peak, and that's close to about 6-7%. And that's not too much. I personally think that we would have finished a one-year time correction September to September. If you have a one-year time correction and 11.5% last financial year growth and about 8.5% for this quarter already, or with the 25 companies, we have seen a 8.5% growth, 166 rupees out of the 1,250 rupees earnings which I was speaking about is already in the bag. So coming back to your question, I think you can't rule that out after a one-year time correction. If there is any trigger of a positive sentiment, if the trade deal goes through a little more better than expected, better than the Indonesian trade deal for sure. If that were to happen, the first 300-400 points will trigger a short covering rally because 86% of the FIIs in index futures are short. I personally would not rule out the reversal, unlike most technical traders would.
Okay. Feroz, how do you see the FI flows to pan out? Because here we have US, which is hitting record highs day after day, given that 86% of the S&P 500 companies have beaten what the street was expecting. But here we're still finding, lesser cheers compared to what the US markets have been faring. So how do you see the FI flows to pan out, given that, so far this month, they have been net sellers for Indian markets?
Lucia, I look at FIIs as not one bucket, a three-bucket group, because unfortunately they're called FII, but there are three very distinctly different behavioral patterns. FIIs who invest in indices, on index funds, they have trillions of dollars collected, the vanguards of the world, who follow the MSCI and the FTSE indices of India or emerging market small cap. Those guys are long. They have been adding a lot of money. Whenever there is uncertainty, the second category, which is hedge funds and active fund managers, go light on emerging markets. That's the second category. Third is prop traders, especially if I have to give you some examples. If you go into balance sheets of institutions in the US, you will see India exposures like Harvard and stuff. When their funding has stopped, they've started withdrawing money. So prop traders, active fund managers, passive. Passive has been a net buyer in India like how? And that goes unnoticed because the other two buckets are in stress. The net flow from FII from FY21, I'm giving you a number which will astonish people, is zero. FY21 ke baad, we finished about 3-4 quarter years. The net buy purchase is zero. But on the same side, in the last 4 years and a quarter, DII purchase has been 15 lakhs, close to 15 lakhs, preceding a 2 lakh number for 8 years. So I personally think DIIs will pump in about 7, 8, in the next 8 years, will pump in about 45 to 50 lakh crores minimum in the capital markets. And index funds of FIIs will continue to pour in money, which they are, but that's being camouflaged by the other two buckets, overpowering the outflows.
Okay, overpowering the outflows. Feroz, let's talk a little bit more about earnings, because yesterday we did see IndusInd Bank now reporting numbers, and you can see that it did deliver, above what the street was expecting. However, across the private lenders, we can see that the loan growth has been quite sluggish. Margin pain point continues. So how are you positioned towards the private banks versus the PSU banks at this stage?
See, how we look at banking as a sector is we look at it initially on the Nifty Bank. There are about 12 stocks in Nifty Bank. 9 of them have given results. There has been a degrowth of 13.5%. I personally think that if you look at PSUs and private banks, I would bet on private banks even today. Because what's happened is their P's are low, that's okay, but there is 82.5% free float of the bank Nifty Bank index, which is the highest free float index in different sectors. What does that imply? Higher the free float, higher the index fund weightages. So you have a lot of common stock being gobbled up by passive fund managers. See, if you double the weight and remove the promoter, the index funds weightages double. That implies a lot of foreign money comes in. So I personally think I would bet with the private banks because their free floats are significantly more than the private public sector banks. That helps index funds exposures being high. That means that there is not too much free float. There could be an optical free float, but the implied free float is negligible. So I would, from a demand supply standpoint and even the business model standpoint for the next 3 years, bet on private sector banks than PSUs.
Okay. Apart from private banks, anything else that you're finding comfort at this point of time in the market?
I think I will position myself, if I were to choose sectors in auto and IT for a reversal. Might be too contrarian for somebody to accept, but I think Nifty Auto degrew last year by 2.6%. When earnings are down, you get downward re-ratings happen. So I think once the earnings base go down, and earnings start reviving, then you get both the benefits. It's a double whammy. When it goes down, it's a double benefit when it goes up. So I would bet for these two sectors to come back with a bang and beat Nifty by about 3-4% at least per annum for the next 3 years.
Okay, quite a contrarian play that you are pointing out right now, Feroz. But I'll stick on to the IT sector because that has been seeing a negative momentum on the back of TCS announcing a 2% cut of its global workforce. Do you believe that we could see a similar impact across the sector as the AI spending goes up?
See, I think what happens is if you look at the narrative and the earnings, IT companies, all the 10 have given the results and about 10.3% is the growth for the last quarter. And that is one sector again, but it has a low free float, but 46% is the free float in IT. I personally think, of course, Indian IT is a very agile business. See, it's like it is not gunning for big innovation. That's actually an advantage. People see it as a disadvantage. The agility for a SaaS platform or a BPO kind of a setup, you're not wanting to pitch in as an innovative partner. You're trying to make sure that you take the dirty work from those innovative partners. If that's what you're going to do, there is going to be relevance. I was drawing up an analogy. You can go into LED bulbs or whichever bulbs, but you will still need an electrician to fix those. So I think that agility is what IT sector of India has shown. You may want to look down upon them for the lack of innovation, but I think there is agility which makes up for the lack of innovation.
Okay. Feroz, if I have to bifurcate the auto sector at this point of time, anything that you're liking particularly compared to your two-wheelers and of course your four-wheelers in comparison? Because while we are seeing some rural-focused stocks still seeing good momentum, for instance, your tractors are still seeing good momentum, but four-wheelers is where the pain is being felt because of the month-on-month decline in sales data too.
Yes, I would bet for the four-wheelers. On the contrary, if I'm going contrarian, then I'll go all the way. Because what happens is I was looking at the kind of competition protection which auto sectors enjoyed over decades in India. And there was a risk to it, but I don't think that's a risk as big. I think I would bet on four-wheelers and buy them at these levels, then go into something which is a momentum play. If I'm going the value way, then you go all the way.
Okay. Also, for the entire global automotive industry, what is your viewpoint? Because right now we have had deals with EU and Japan as well from the tariff fronts. But India's, of course, we still don't have any deal. But do you still see this as a positive sign, given that the tariff deals earlier was quite higher in comparison, and that's why we could see some good momentum going ahead?
See, global auto, I don't track. I personally think that I think whatever tariff reductions are going to impact the really high segment. If you look at the deal you have with Britain on 110% import duty on cars coming from UK will come down to 10% in a gradual fashion. But that's not the segment in which the Indian automakers operate. So I personally think that yes, the tariff war I thought would create larger collateral damage, and now I would discount my opinion and say that I'm a little more bullish from that side.
Okay. Feroz, let's get your view on new age stocks also, because plenty of them have been reporting good numbers, be it Paytm, Zomato, or even Car Trade Tech yesterday, profit more than doubled. Do you believe this is a good time to hunt some of these names?
If you're doing the momentum plays when you can go into these new age businesses, of course, some of these businesses have got into Nifty and some really large indices. Now, if you get into Nifty, like one of the four changes was a new age company, then there's about 8-9 lakh crores of AUM of EPFO in Nifty. So even if you have a 1.6% weightage or 1% weightage, there is 8-10,000 crores of money coming in. That creates a lot of traders coming in. So it becomes a self-fulfilling prophecy. If you're looking at earnings and looking at new age companies, that's a wrong direction to look at. If you're playing momentum, you have to analyze demand and supply, and you can always, with regression models, project demand and supply, and then take the bet and get out of them. And earnings is not going to be the biggest Sahara for a new age company, to my mind. And earnings still don't justify a 500, 700 P, whatever be the growth you might want to project. But what happens is if a company comes into Nifty, then you have 8 lakh crores of AUM minimum tracking Nifty, and every month you get an inflow. And that makes sure that the domestic institutional holding goes up. And that creates more faith in the trader because it breaches all the resistances on the higher side. Then you have the fundamental guy saying the domestic institutions have increased it, so I will increase it. And so on, that becomes a self-fulfilling prophecy. And when that same trade gets unwound, is when people get caught on the wrong foot. So you will know when to get in, you will need to know when to get out. If I have to drop an analogy, it's like the chabi gudiya. When you actually triggered a good winding, it also unwinds when you let it go. So you have to get out before the unwind starts.
Okay, supply demand dynamics, that is what we need to watch out for. But since you mentioned a lot of them, a lot of things that you're positive on, anything that you're cautious right now in this market?
See, I've not, so of course, there are so many things you would be cautious on, but I personally think that the FMCG space is something which I would say structurally over the next 2-3 years can get derated.
Okay, FMCG. You are playing with two swords here, if it was, because so far you're playing on the contrarian bets of auto and IT, and where the street has been bullish, conservative on, and the street has been bullish on consumption, and you are quite conservative over there. So yes, quite an interesting
All
thing that
depends
we
on
have
the
had.
time frame, Lovisha. See, if somebody, most of them would be looking at a 3-month trade, a 6-month trade. I address those sectors which can give me that alpha of a Nifty compounded 3 to 5%. And that's when you go overweight on a specific sector. So, of course, there are momentums you play. You will make a lot of money if you know when to quit. So the period differs between most people who would be on your show. And that's one of the core reasons why you're looking at a sector with a specific objective. Which sector can beat Nifty by 3 to 5% compounded over 3 years?
Okay, all right. All right, with that, we have to let you go, Feroz. Thank you so much for your time, and we hope that we connect with you soon.